Self-Directed IRA Saturday webinar here with Quest Trust Company. I am super excited to have with us today Feras Moussa from Disrupt Equity here in Houston, Texas. And today we are going to be talking about how to see a multifamily deal through the eyes of the passive investor or something along those lines. So I'm really excited for today's class. But before we get started, I do just have a couple of quick announcements for you guys. I know in these webinars, we get a lot of new people joining us every single week. So we'll kind of walk you quickly through about who we are at Quest and how we can help you as you're investing in real estate. That have been joining our classes for a while. I have updates for our events, our monthly promotions, and some more of that fun standard stuff there. So really quick, who is Quest Trust Company? Quest Trust Company, at the core of our business, we are a self-directed IRA custodian. So we basically teach investors how to utilize their old 401ks or IRAs to invest into assets outside of the stock market. So our clients use their IRAs to invest into privately held assets such as real estate, multifamily deals, private lending. You really have a lot of options when you're investing with your IRA, and it's totally self-directed. So you actually get to choose where your money is invested. But along the way, as you're learning about how this process works, the rules when you're investing with your IRA, our team is basically here to help you throughout the entire step of the process. So you guys will notice that I do actually have one of my coworkers online on this webinar with me today. His name is Evan. He's actually one of our IRA specialists here in Houston. So if you guys have any questions about investing with an IRA or just any rules of self-directed IRAs, be sure to send Evan a chat throughout this webinar. He'll be here the whole time, and we're happy to help answer those questions for you guys. We are a pretty good sized company. Physically, we are in Texas. We have offices in Houston, Austin, and Dallas, but we do operate in all 50 states. We have clients all across the US, and we have about $2 billion in assets under our management. Now, all of that $2 billion in assets under our management is all privately held assets that our clients self-direct their IRAs into. So there's a lot of people doing this, even though most of the country, has no idea you can invest an IRA into real estate. At Quest, we do a lot of education over all of these different types of topics. So you can not only learn how to invest with your own IRA, but if you happen to be in the shoes of where you're raising private capital for your deals, raising private capital from self-directed IRAs can be a great option for you out there as well. Now, my last bullet point on this slide is our disclaimer. This is really important. Please be aware that at Quest, we do not give tax, legal, or investment advice. It is totally up to our clients to do their own due diligence before they enter into investments, either with their IRA, non-IRA funds. Guys, please make sure that you're taking the time to not rush into deals with people that you don't know. Work with professionals. Make sure you've had professionals review your documents, the investments, anything you might be investing into. Really cannot stress that enough. So always got to make sure we get that out of the way there. Now, onto some of the more fun stuff than the disclaimer. At Quest, if you guys are currently a client, I would definitely recommend that you guys go check out our online client portal. Through the client portal, you can upload all of your investment documents. You can get real-time updates from your transaction specialist as you're uploading new investments to be funded with your IRA. And you can also keep track of all of your investments, expenses. You can generate custom reports for your accounts and any incoming funds you might have to your IRA. And we also have a really nice secure document upload. So if you have any sort of documents that you need to send into Quest, it's a bit more secure to keep them out of your email these days. So you can just log into your client portal, upload them directly to the department that they need to go to. And it's a really nice way to get us your information very quickly whenever you need to, as well as keep your personal information safe and a little bit more out of your emails if we can help it. So if you guys are currently a Quest client or if you're looking to join Quest, definitely make sure to check out this client portal. We have a lot of great features through there that make keeping up with your account pretty easy. Now, today's webinar is just one of many classes that we host. Not only do we host a lot of webinars, YouTube videos, and education on our website, but we also have several IRA specialists that are here to help you through the entire step of the process. So it's really easy to get a hold of us at Quest. It is something that we really pride ourselves on, is our high quality education that we're able to offer to our clients, non-clients, investors, pretty much anyone who's interested about learning. We definitely have a lot of resources for you guys. And we're really excited for the in-person events coming back. Obviously some things are still crazy out in the world right now. So at this time, all of our events have gone back to online. If you guys were registered for the grand opening events in Austin or Dallas, those have now moved to virtual presentations. I'm really sad about it. We're really looking forward to seeing everyone, but we will still be hosting this education online. If you are registered for those events, you should have received an email yesterday to let you know, and we'll probably send out another one next week because there's a lot of people that miss those emails sometimes. But we do still have a lot of networking opportunities for you guys out there. Definitely join us at the virtual networking happy hours that we host twice a month on the first and third Wednesday of every month. You can find these virtual happy hours online on our website under our events page. There you can see all of our upcoming webinars, you can register for our events, and you can see the latest updates when we do bring back those in-person events, hopefully once again here soon. Also, on to this month's promotion. We're giving away money all quarter long through the end of September. We've actually extended this because it's been really popular among our clients, but we're giving away up to $500 in fee credits to anyone who is looking to either start an IRA at Quest and move some funds over to get started, or if you are an existing client, you still qualify for this. So if you guys have an upcoming investment, I know, guys, real estate is really hot right now. There's a lot of deals out there that need to be funded. Definitely consider doing some of these investments in your IRA if it's a good fit. And if you move your funds over to Quest by the end of this quarter, we'll potentially give you up to $500 in fee credits. Evan, who is here in the chat with me today, Evan, put your contact information there. If anyone has questions, reach out to him. He's a great point of contact for you guys to help you get started. Also, on those lines of getting started at Quest, you guys know in real estate, we get a lot of our business by word of mouth. So if you are self-directing your IRA and you're having good experiences, be sure to tell your friends, your colleagues, your family about it. You never know who might have money sitting in an IRA that's looking for somewhere else to invest that they actually have more control over where their money is invested. So if you refer a new client to Quest, you will each get a $25 credit. Keep an eye out. Sometimes we do little flash promos where we do double the rewards. We don't have that going on right now, but there's no limit to the number of clients that you refer over to Quest. So for more information about that, visit refer.questtrust.com or just reach out to an IRA specialist. And that is about all that I have for my announcements today, guys. So check out our events, check out the client portal, tell your friends and family about Quest because you never know who might be looking for other places to invest their money. So reach out to us if you have any questions and we're more than happy to help. And without further ado, I'd like to go ahead and bring back Feras Moussa. Feras is one of the principals of Disrupt Equity here in Houston, and he's here to talk today about some things you should be looking out for if you're looking to passively invest into some multifamily deals. So Feras, go ahead and take it away. We're excited to have you here today, and it's great to see you again. We'll come back on at the end for some Q&A.
All righty, I'm glad to be here. Thank you, Haley. Thank you, Quest. And I know you guys can't make recommendations, but I can make recommendations, right? And as mentioned, we have lots of passive investors with self-directed IRAs. Quest is easily the number one of them, right? The most popular as well as just ease of use. And so, thank you, Haley, and I'm glad to be here. So, with that said, right, I know we're all here to basically learn about multifamily deal analysis. And not from kind of the operator lens. I know there's a lot of content out there, but really we wanted to kind of pivot a little bit and talk about kind of what it looks like from the passive investor side, right? And so for those that don't know me, I'm very candid, happy to kind of dig into some of the details. And it's really meant to give people an overview of all the different kinds of things you can dig into and ask questions about as a passive investor. And so with that said, my name is Feras Moussa, managing partner at Disrupt Equity. We are a vertically integrated company based here in Houston, Texas, and we buy properties throughout Texas and Georgia. We've had many deals go full cycle, very strong record, and I came from from tech. So I was originally at Microsoft, had a software company, and found real estate and fell in love with it many years ago. And so, ultimately what we do is we help investors identify attractive assets to invest in. We acquire the property, operate the asset, and, with the goal of obviously getting distributions and returns to our investors. But let's kind of get it kicked off, right? So, you have a deal, right? And what does have a deal mean? It means, someone told you about it, it hit your inbox, and you're just kind of scratching your head as to, okay, what should I do with this, right? How do I go about determining if it's a good deal or not? Right? As Haley mentioned a few minutes ago, there's a lot of deals out there. There's a lot of equity out there, but there's a lot of people that are looking to get deals funded. And ultimately, as a passive investor, it's about being patient and doing your due diligence. And as the operator, right on my side of the table, it's also about being patient and doing your own diligence. So I'm going to walk through a set of things, and there's really two sides to it. There's the passive investor side and the operator side. And I'll speak a little bit to the operator side, but I'm going to focus more, kind of from that lens of a passive investor. So that said, you get a random deal, who knows where it is, right? What should you kind of start to do? Right. First thing is really think about the macroeconomics of the deal, right? We've bought properties in Beaumont, we've bought properties in Atlanta, we've bought properties in San Antonio, and we've seen different things across each of them, right? And ultimately, as a firm, we've really made a conscious decision to focus more on kind of primary markets, right? Versus, Beaumont, we've had 3 deals, we've done home runs there, right? But you never know how quickly you can exit a deal. You never know how much demand there is, right? And so really understand the macroeconomics. We don't invest in a city that doesn't have a growing population, doesn't have a growing economy, doesn't have a diversified economy, right? Those are kind of definitely the most basic things. But from that, right, really understand average income of that submarket, employment, and proximity, right? Who is going to live in that asset, and does it make sense, right? And really a good example is, if the operator is trying to get $1,000 rents, if a person makes, let's just make it up a number. Let's say that person makes $12,000 a year. Can that person support paying $1,000 rents, right? That's almost 10% of their income a month, right? And annually it's the whole thing. Obviously not. And so really understand what projections you're trying to do versus that submarket. And a couple of other things, right? Landlord friendly taxes, right? There's some things to think about there. You don't want to invest in a place where it's not landlord friendly, and essentially it's going to make operations a lot more complicated, right? We saw what happened with COVID. Evictions stopped across the board, but at the same time, right, we still had, being in the markets that we're in, we still had more tools at our disposal than someone maybe in California. And so really understand that, and pricing, right? Ultimately, does the price point of that asset make sense in that market? And I'll kind of dig into that a little bit later. And ultimately, I'll buy a deal anywhere, right? Doesn't matter if it's Topeka, Kansas, or if it's the middle of New York, but it's got to be risk adjusted. And that's my takeaway. So even if New York is not very landlord friendly, right? If I can buy it at the right price point, reduce, essentially get the type of returns for that much more increase in risk, you can do it. But ultimately, these are really just kind of key things as a investor to think about as to what is your risk tolerance, right? Everyone has a different risk tolerance. Every operator has a different risk tolerance. And, does it align with what your goals are, right? And can you, complete that? And maybe I'll add one more thing, actually 2 more things. In terms of goals, right? It goes back to what I said. We invest in a tertiary market or secondary market like Beaumont, and we can get cash flow. We can, really perform in terms of distributions. But you don't get the quick in and out on those types of deals, right? We've done it kind of almost, I'd like to say accidentally, versus in Atlanta, right? There's a tremendous amount of demand. We're selling off many assets in Atlanta right now because it's just a really attractive market. A lot more people looking at that market. And so understand what your investment strategy is and what can you accomplish. And there is one website I do recommend, citydata.com. It's got a dash in between it. It's a really, really good source of data on pretty much every city, and it really drills down into a lot of things. And one of my favorite things is really the map. There's a map towards the bottom. Use that map and start to turn on some of the overlays. You can see what specific areas within a city has started to get income increases or started to get, crime increase. I mean, there's a whole variety of things. And really, we like to basically overlay where the asset that we're looking at is and start to kind of identify, okay, where is that deal relative to what's going on in that city, right? And this is really something that as a passive investor, you do kind of whenever you're new to a market, right? Once you understand a market, you begin to kind of be able to tell that pretty quickly. But it's definitely in the very first place to start, regardless of what deals or returns the operator is projecting. This is the very first thing in terms of just getting comfortable with that asset. Next up is really, digging into the financials. And this is going to probably lose some people, right, in terms of just complexity. And I'm going to get back to this here, but just know that any deal that is being bought, right, is going to have what's called the T12, trailing 12. It's basically the P&L of that asset, right? And the sponsors, usually sponsors don't give this out, but as a passive investor, you can ask for it, right? If you're working with a sponsor that's not giving you data, you have to ask yourself, do you want to invest with that person? I apologize. I am presenting slides, but I think I totally forgot to turn on the screen share. Let me do that right now. I saw that comment come in. Can you all see my screen? I think so. All right. I apologize. I'll flip through these for whoever saw it. That was slide 1, 2, 3, 4, 5, and this is where I was at. So this is an example of the T12, the trailing 12 financial statement that I mentioned, right? You can ask your operator for this set of this set of information. And as a passive investor, right, your goal is not to really become the expert in the financials, right? That's a lot of work. That's probably not what you're looking to do. But what you're trying to do is understand the story the operator is painting, and does that mesh with what you're seeing, right? And a really good example that I like to do as an operator or a passive investor, right, is really look at a couple of things, looking at what was the total income collected in year 1, and what is that operator trying to get in the first year that they own the property. And, is it a 10% increase? Okay, that's doable. If it's a 30% increase, that's probably not doable, right? These properties have people living in them. People move in and out periodically, right? You can't just all of a sudden push rents across the board, especially if you're doing a value add, right? Most deals have a value add component, which ultimately means we are going in, the team is doing upgrades to the interiors, maybe putting in better flooring, new paint, new cabinets, right? And asking for a higher rent premium. Well, that all takes time. And so as a passive investor, you're trying to understand the story in terms of where the deal is today, what is the operator trying to do year 1, what's he doing year 2, and does that all make sense, right? If I told people, hey, I'm going to, build a shuttle to Mars and we're going to be there next month, no one's going to believe me, right? It doesn't make sense. But if I said, hey, we're going to work on building a shuttle to Mars, we have a 30-year plan, and here's our, data points that we're going to hit along the way to get there, well, it becomes a lot more realistic. And so that's really, as a passive investor, what you want to be kind of digging into and understanding. And the other side of it is also asking for what's called the rent roll. So this is a sample rent roll. All a rent roll does is basically list every single unit, and it lists out essentially who lives in that unit and what is that person paying for that unit today, right? You, as the passive investor, again, are trying to see the units that are currently occupied, what rents they are currently collecting, and really trying to identify, okay, this unit is getting this rent, the operator is trying to get this, right? And really dig in and understand, what is that size of the unit? Is it a 2-bedroom, 3-bedroom, 1-bedroom, right? And ultimately, where are they today and where are they looking to be, right? That's another big piece of the thing that just to kind of, dig into as a passive investor, right? Again, your job is not to be the expert in all the nuances of the financials. If that is something you enjoy doing, by all means, please be there. But I really believe a educated investor is a good investor, right? And it's your, it's really your fiduciary duty to yourself to understand the story, and does that align with what you're looking for as an investment. And so whenever an operator buys a deal, right? So on my side of the table, whenever I talk to a broker, really the 2 files that I always need is the T12 and the rent roll. Those are the 2 most important files, even a lender, right? Because again, we're trying to understand where the asset is today, performance-wise, right? And that includes financials as well as who's in the unit, and that's what the rent roll shows you, right? And then ultimately, what is the story that's going to get it to push the rents, to be able to collect the higher income, to be able to give the distributions needed for an investor. All right, so that is a rent roll. I'll keep going. Next up is, again, you're digging into the deal, right? Understand the asset condition. Is it a 60s asset or is it a 2010 construction, right? We've done both of them. Both of them have very different demands. And ultimately, as a passive investor, the question you want to ask is, what is the deferred maintenance on the asset? And pretty much every operator will go through what they are going to spend CapEx, right? Which is basically, money onto. and walk through that. But if they didn't, well, that's probably a little bit of a red flag. And so understand what the condition of the asset is today. And as a passive investor, if it's nearby, you can go drive it. By all means, please put eyes on the asset, right? We buy properties in Texas, Georgia. Obviously, our investors can't be in both places, right? But if it's nearby, go put eyes on it, right? If it's your first deal, go put eyes on it. Go begin to understand the deal, because you will get educated and see the before and after. You'll see what was presented, what happened, right? I think it's, most people on their first deal, there's a lot of, there's a lot of butterflies. They're nervous, right? But helping kind of get past that, getting educated, and then it becomes a lot more easier to understand future deals as well. But the big thing is, again, understanding the story. So, for example, if I'm buying a property and I know all the roofs are shot, right? And you as a passive investor, you go out there and you look at them, you can see the roofs are shot. And we're saying, you know what, we're going to put $100,000 into this property. It doesn't make sense. It needs at least $500,000 of roofs, right? And so again, understand that piece of it, right? What the operator is positioning. And really that leads to one important thing that I think really gets glossed over both by operators and passive investors. And we've learned this, right? We've done 13 deals and we've learned the good, the bad, the ugly. And it's just about being well capitalized on older assets, right? If it's an older asset, there are still, as much as you think you're going to know where all the bodies are buried, there's always going to be things that come up. And make sure that the investment has a lot more buffer, a lot more runway for just the what ifs, right? And so again, it goes back to what I said earlier about risk adjusted. So now if you're buying an older asset, it's got a lot of these, skeletons in the closet. Well, obviously you need to be getting a better return than if it's a newer deal, straight down the middle, et cetera, right? The problem is for the newer deal, you're paying a higher premium. You're not going to get the kinds of returns. And so it's that balancing act, right? But I think deferred maintenance is one of those things that people really, passive investors don't know how to interpret it, don't know what to look for. And I think operators tend to gloss over because, again, an operator is just trying to financially see if the asset performs, right? And so that's a big one. And, once you've kind of gotten past that, you understand the high level story, right? You understand where it's at, where it's going, what we're trying to do, what problems the property has, right? You can then start to really dig into the numbers a little bit, right? And so now this is where I may lose some people, so I'll be kind of brief. And again, I love Q&A. I'm here to answer questions all day if people want it to, and I'll let people ask questions kind of at the end of this. And so if you get a little bit lost, do not hesitate to ask questions. I'm always happy to. So really the first thing is what we call normalizing the T12. So you took the financials, right, that T12, and there's a couple of things. And again, as a passive investor, you're not going to be an expert in this, but you're looking at a couple of key bullets, right? First one is consistency on the expenses. Did the property, today, I'm just going to make up a number, let's just say it has $1,500 a unit in payroll, and the operator is projecting moving forward, we're going to be at $1,000 a unit payroll. Okay, that's a little bit of a red flag, but maybe there's a real reason there, right? Let's pick landscaping. I mean, landscaping is landscaping. You're not going to save a tremendous amount of money on landscaping. But again, if that property's got beautiful gardens and rose bushes, and the deal today is spending, $2,000 a month on landscaping, and the operator is saying we're going to spend $500 a month because our property down the street is $500. Well, again, you have to kind of pause there and ask yourself, does that make sense, right? Because maybe the property down the street has very limited grass, whereas the property they're buying is, got a big amount of landscaping to do. And so really you're looking for consistency. And anytime there's not consistency, right, it's not necessarily a deal killer, right? It's a, hey, it's a warning, right? Let me go understand what's going on here. Is there a valid reason for that, right? And sometimes there is, and sometimes there's not. The other one, adjusting for taxes, and this is probably one of the biggest, simplest ones. As a passive investor, you can see and understand, and as an operator, they should be doing, right? Which is ultimately, we are buying assets. Taxes do go up, especially if you're in Texas, right? Especially in Houston, we're buying properties in Houston, and taxes go up, right? Right now, we have a deal that's going to close that's 2 weeks. That's a $56 million purchase. Currently, that deal is appraised at about $41 million. So they're paying taxes on $41 million, right? They have a very good tax attorney. They've been able to get that down pretty low. Well, guess what? Whenever we buy it at $56 million, there's a very high likelihood that now the appraisal is going to come in at $56 million on the tax side, and we're going to have to start paying taxes at $56 million. So our taxes will go up significant. What is that? About 20%, right? And so make sure the operator is adjusting for taxes. And this is where you ask them, hey, what are you modeling year one in taxes versus where it's at? And as a passive investor, you can look all this information up. You can look up what's called the millage rate online, right, for a property. You can go understand what the tax rate is, right, similar to houses. And you can also look up what it was appraised at currently, and then you can ask the operator what they're buying it at. So again, in that model that I mentioned earlier, I'm just going to make up numbers, but the deal we're buying, today it's appraised at $41 million. The tax millage rate is about 2.6, I think, right? And I know I'm buying it at 56. So somewhere in between there, right, is where taxes are going to land. And most likely it's going to be closer to the purchase price than not. And so as a passive investor, you really want to understand that, because this is a huge dollar amount. And I've seen deals completely blow up from other operators where they did not adjust for taxes. They did not really think taxes are going to go up that aggressive. And I'll add one last thing, is it varies by county significantly, right? We know if we're buying a deal in San Antonio, Bexar County is an extremely aggressive county. We model the deal at pretty much 100% of the purchase price. But whenever we're buying a deal in Beaumont, we know Beaumont is a lot less aggressive. So we can model at 90%. And, so kind of keep that in mind. And I'll add one last thing. Since those of you, being on Quest, I'm guessing most people on this call are from Texas, right? And we're kind of used to the Texas model. Well, just realize in other states, taxes are done differently sometimes. So for example, in Georgia, what's nice about it is taxes are done at 40% of the appraised amount. So going back to my example, we buy an asset. Let's say now, it got bought for $56 million. Well, we only get taxed at 40% of the 56. And so as a passive investor, if you're looking at numbers and you're like, wait a second, this person's only modeling $400,000 in taxes and it should be $1 million, understand the state and what's going on there just to make sure you don't have a mistake on that. Next up is other income. And so other income is usually the leading place at an operator, right, after rent, that we can continue to push collections, right, get more tax in. And as a passive investor, you want to really look at the other income of where it is today and where the operator is projecting to get a sense of if it sounds realistic, right? So for example, we can buy a property, we can install carports. There is a cost for carports, so that needs to be in the capital bucket, right? But we know for carports, I maybe can charge $30 a month in extra rent, right? And so carport is other income. If I put in 10 carports, that's another $300 a month, right? And so as a passive investor, you want to understand what the deal is doing today and what are the opportunities that are going to allow for pushing the other income higher, right? And again, does that all make sense? Or is the operator saying, you know what, we're going to start to do things that maybe aren't normal for that market, right? Utilities is a good example. Some markets, they're all bills paid, some markets aren't. And understanding, does it make sense for your market? Because maybe the operator is saying, you know what, we're going to basically, moving forward, we're not going to be all bills paid, but we're going to keep the rent the exact same. Well, that may not actually make sense, right? Because again, maybe if you're not dropping your rents, now all of a sudden you have a lot more costs on the tenant. And if it doesn't make sense for that market, they're going to go elsewhere, right? So really understanding that piece of it. And again, one more thing, just take a quick peek at one-time income expenses, right? This is where you're just looking for red flags, right? And I'll give you a real example. A lot of properties you'll see essentially where they got a one-time $50,000, $100,000 check from a cable provider because they signed a new cable contract, right? Well, that is really not consistent income. That's a one-time thing that just happened, right? Make sure the operator and yourself are not including that as if it's normal income that's always going to happen, right? Because usually those contracts are 5-year contracts and it's not going to happen for another 5 years, right? And so you're looking at a couple of those. And then last but not least, there are rules of thumb, right? And really, as a passive investor, that's probably the simplest thing, is to see where expenses are and what the rules of thumb are. If you want to know rules of thumb, please reach out to me. I'm happy to kind of share that information. There's a couple of sites for that, but you're looking at things that make sense. And so the simplest one is actually back to that payroll example I told people, right? The rule of thumb on a B, C class asset for payroll here in Texas is you're looking about $12 to $13.50 a unit, right? So in total, right, let's say it's a 100-unit property. You're looking for each unit, you're going to spend about $1,200, $1,300 in payroll total, the combined amount of staff that across the whole property, right? Now, if a property currently is $1,800 a unit, I, as an operator, I looked at it as, hey, there's a chance for me to probably operate this deal more effectively and then save some costs there. But now, again, you have to dig in and understand, why is it so high, right? If it's an A-class property, well, that's different, right? There's a different level of service expected at A-class properties, a different amount of attention needed, and maybe the payroll will be higher. But again, is $1,800 too high? Well, rule of thumb says lower. So, you want to understand that, right? So there's a bunch of rules of thumbs to kind of keep in mind. And last but not least is really just kind of market survey, right? This is really key, people. And this is, as a passive investor, you can do this yourself, right? We have a team that literally all they do is market surveys weekly on every property, right? It's really calling other properties, understanding what they're charging for what, and understanding where that lands relative to us. So as a passive investor, right, let's just say you got presented on a deal, call the property across the street and down the road. Call those properties, understand what are they charging for rents, and ask, are they upgraded units? Are they not? Are utilities included? Are they not? Does it include washer and dryer? Or does it not? Right? Is it, what's the condition, in terms of upgrades? You can ask these kinds of things and you can take notes, right? And you're essentially putting together a market survey and understand, hey, is the deal that I'm going to invest in, is it what's called below market? Or is it already at top of market? I toured in the past week, we've toured probably 6-7 deals here in Houston. And on one of those deals, I remember, everything was already updated. It was a nice pricing for in terms of price per pound, but there wasn't much upgrades. There was no pushing rents, right? Everything was already done on that property. And we called around, and again, it's already pretty much near the top of market. And so for me as a buyer, I didn't see an opportunity to really push my income and my revenue, right? And other people may say, hey, that deal feels good, price per pound, but you're not going to be able to make any more money from that. And so again, it's about understanding the investment and what that looks like. And so, as a passive investor, market survey is key. You should do your own market surveys. And, you can ask the operator, hey, they should have done a market survey. Can you please send me, what market survey you have or who the comps are, et cetera, so you can make your own calls. But really, you're trying to understand the pricing. And I'll say this too, as a passive investor, so operators tend to show market surveys price per square foot. They really do. And I really hate that, to be honest, because I've never seen a tenant basically say, okay, this is a 2-bedroom. Let me pull out my measuring tape and make sure I'm getting more space, right? Now, yes, a tenant can feel the difference between 1,000 square feet and 700 square feet, but they're not going to feel the difference between 1,000 square feet and 950. And so really, I like to personally look at just, hey, a 1-bedroom for a 1-bedroom, a 2-bedroom for a 2-bedroom, right? What does that look like, right? And so again, as a passive investor, this is very easy to do, and it really can help you understand the deal and see if it makes sense, right? Keep going. And so next up is really the numbers get plugged in, right? And again, this is a very complicated screen. I'm just showing you a sample of our model that we have, right? Where we literally plug in all these things and start to understand what we can do with the deal relative to where it is, and ultimately, right, how much positive cash flow there is. And then from that, right, we also have to model in the splits, right? We, on our deals, right, we typically have a preferred return. So 7 to 8% preferred return. And what that means for those that are on the call that don't know what a preferred return is actually really key. As a passive investor, I don't invest in deals without a preferred return. What it means is basically, for my money invested, I essentially get I get an annual return, which is the preferred return. Let's just say it's an 8% preferred return, which is an 8 pref. I get an 8% return annually on my money first before the operator can take out $1, right? And so essentially it means investors get paid first a certain amount before operators can begin to share in the positive cash flow. And so all of that has to be modeled in, right? And the reason I put this on the screen is not for anyone to dig into this, right? This is a very small piece of it. Really, our model has 15, 20 different tabs on it, right? There's a lot of other things that aren't even shown here, but it's to show the amount of analysis, some of the analysis that goes into this. And you as a passive investor should ask your operator for this, right? And I've had passive investors tell me that their operators will never give them this. And I'm like, what the heck? You are a partner in this deal as a passive investor. It's your money, it's your hard-earned money. So please do not hesitate to ask operators for this and understand what are they doing, right? And so from this, you can quickly see what are the expenses, what are they projecting, and where was it? Where is the income? Where are they projecting, right? Am I seeing big discrepancies or am I not, right? You're trying to get a very simple pulse. And, that's really kind of the model is what we call it. And so again, dig in and understand what the operator is trying to do and ask them for this. Do not hesitate to ask them for this thing. And so I'll keep going. Right. And then a couple of other things to kind of keep in mind, right? And this is really, I'm reaching the end of the presentation. And, as a passive investor, there are a couple of items that you need to understand that can really impact the deal, right? And the first one I want to say is the reversion cap. And so I walked through the slide the model a second ago, right? And if you remember, the model has a bunch of things, but it's really modeling everything that's going to happen in that deal. It's modeling what is the debt that we're buying. It is modeling what is the income that we're projecting year 1, year 2, year 3. And as part of income, there's vacancy, there's concessions, all the things that go into it. It's projecting what the expenses are. It's projecting, how much equity we are raising for our investors and, paying them the return on their money. And it's also projecting what we are selling the deal at, right? And so really we do 5 to 7 year holds. Now we're opportunistic, right? At our firm, we will make an exit when it makes sense. We're selling many deals this year because it's a very hot market, right? But we are still modeled the 5 to 7 year play. And you're kind of throwing a little bit of a dart as to what does the market look like in 5 to 7 years, right? Is it a hot market? Is it not, right? And so one of the things that gets plugged into the model, and it's really, in my mind, the number one most impactful number on a deal, is what is the reversion cap? And to explain what that is, for those that don't know what cap rate is, okay? Cap rate is the number one kind of metric that deals in commercial real estate are valued. For those of you that have bought a house, right, you probably understand your house, the way it was valued is they pulled comps. They looked at the other 15 houses in the neighborhood that sold the past couple of months. And from that said, okay, your house is worth about this, right? Well, in commercial real estate, the problem is you don't have assets that are all very similar, right? In a neighborhood, all the houses are similar size, similar build quality. You can get very accurate comps. In commercial real estate, you don't, right? How do you value the Walgreens, and then across the street from that is the gas station, and then across the street from that is an office building? How do you value those, right? They're 3 very different assets. Well, cap rate is the answer, and what that means ultimately is what the cap is a very simple equation. It's basically the cap rate is equal to the NOI, net operating income, over the value, right? So write that down. And really what that means is if a person bought the asset today, all cash, so take debt out of the equation, just you're buying it all cash, and you did nothing special, all you did is operated it the same as the current owner, right? What return would you get on your investment? That's what the cap rate really means. And so that's how deals get valued, right? So whenever we do things to push rents, right, we are increasing the NOI on the top of the line. So even if the cap rate stays the same today and tomorrow, right, we've actually increased the value of the deal. And so the reversion cap is really saying, hey, Mr. Operator, I'm looking to invest in this deal. What are you targeting as the exit cap rate in 5 years, right? Today, right, the market today for B-class assets in Houston is a 4.5 cap for reference, right? It's about a 4.5 to 5 cap, but more 4.5 than 5. It's a hot market. And if I'm presenting a deal to my investors and I tell them, you know what, in 5 years, we're going to sell this deal at a 4 cap, right? I'm actually saying cap rates are going to continue to compress. My investors will not invest in that deal, right? I mean, yes, it may compress, right? That's what we've seen the past several years, and we've been able to make some really strong returns because of that, but it's not likely, and I'm not going to bet the whole investment on that. And so, instead, you're looking at, hey, where are the cap rates today and where are they projecting? And because the cap rate is how we model that exit price, right? Because again, whenever I present an opportunity to our investors, right, we need to present and say, we are buying the deal at 20 million today. We're going to put $3 million into it. So our cost basis is 23 million. And we expect to sell it in 6 years for 30 million. Great. How did I come up with a 30 million number? Well, what I did is I took the NOI at year 6, and then I calculated, with the reversion cap that I used, the value. And so that one's a huge one because again, it can make a bad deal look good and a good deal look bad. Next up is the debt, right? Understand the deal. There's debt and then kind of the structure, and I'll get to that one in a second. But with debt, you're trying to understand, again, how much leverage is the deal going into, right? What does that mean? And, is it an agency or is it a bridge? And so in our world, there's really 2 kind of models. You can go with a deal with agency debt, Fannie and Freddie, right? Similar to house, same kind of government regulated debt. The problem with that debt is that it's really usually, right, it's fixed and long-term. And, I'm learning this the hard way. We have a deal that we're selling in Atlanta that closes in 2 days, right? On that deal, it's a smaller deal. We have a $3.5 million loan. We're going to pay $1 million penalty for selling early. Now, we're going to still perform tremendous for the investors, but that would have been nice to keep that extra $1 million, right? We had agency debt. We weren't expecting to sell it so soon, but we've performed very well, the market taught, and we're still paying that. And so understand the debt that your deal is going into. If a person is telling you, look, we're going to go get fixed agency and we're going to sell it in 2 years, that's probably not a well-structured deal because that person is kind of glossing over what that penalty may be, right? And that's where a different tool comes into play. It's called bridge debt. So we have something called bridge debt. For those that come from residential, it's kind of like the hard money loans and, for flippers, but it's a little bit different, right? In terms of, much more attractive, lower interest rate, et cetera. And those lenders will lend you, the loan for 2, 3, 4 years, right? And with the goal of getting the deal performing right, implementing that business plan, and then doing a refinance out back into an agency. And so as an investor, you just want to understand what that looks like, right? You're really trying to understand the risk. I tell people some investors want no risk and they're happy for low returns. Some investors will take tremendous risk and they just want the highest returns. Understand where you are. Understand if the deal matches what is being told, and does it all meet your criteria, right? Because again, and I'll give a really good example. There's another deal in Atlanta that we're selling. We bought this deal. We intentionally went lower risk. So instead of going 80% leverage, we did 65% leverage because it gave us more interest only in the loan, right? We get 5 years of interest only instead of the 1. And on that deal, our investors loved it. We went low risk. So that meant, we went low leverage, which meant a lot less risk. And the people that invest $200,000 per deal, they came in and invested $800,000, right? It was kind of interesting to see the dynamic. And so you as an investor, you just want to understand your risk appetite and what the debt means for that, because the debt is the biggest cost on a property. So make sure that there's enough positive cash flow, that it's not a deal that's 95% leveraged and there's, really, really, really tight cash flow that, hey, if you have a bad month or COVID happens, right, that you're now belly up and you can't even service the debt on your investment. And then last but not least, right, structures and splits. Understand what that is. That's the other big thing. If as a passive investor, if you took nothing away from my presentation except for these 3 things, you've already significantly moved the needle, right? Understand the structure, right? And I mentioned earlier preferred return, what that means, right? And understand what the splits are after that. Is it a waterfall or not? And waterfall means that investors make a certain return up until a certain metric, and then after that, the splits change again, right? And just get comfortable with it. This is where you should spend spend some time in and just understand, right? Our deals today, most deals we're doing are 7 or 8 pref and a 70-30 split. That's how we talk about it. What that means, investors get the first 7 or 8% annualized return on their investment. And then after that, any leftover residual profits, 30% goes to us, 70% goes to the investors, right? And whenever we present numbers to our investors, we present net to investors. They're not having to go figure out, hey, okay, here's the total collections, here's the 70%. We've already done all the math for them, and it's presented to investors that way. As a passive investor, if you're investing with other people, please make sure that that's what they're presenting. Because I've seen people that present it as total returns, right? In terms of, hey, this deal makes this much positive cash flow, but they haven't done the math to really say, okay, yeah, but we're taking, if I told someone, hey, I'm going to give you a 10%, this deal makes 10% return, but then I'm keeping 3 of it. Well, really, you're only getting 7. So understand what's being presented to you and what you expect to hit your bank account end of day. And so with that said, I think that's my last slide. So yeah, that's really all I had in terms of key things for passive investors. I wanted to make sure I left 15, 20 minutes, and I think we are, perfect on time, 15, 20 minutes just for people to ask questions. I'm happy to talk through them, right? I've included my email address. Please feel free to reach out to me, people. I am more than happy to meet and talk with people and, connect with the rest of our team, right? Disrupt Equity, we have, Disrupt Equity, Disrupt Management. We have our own management company, and we have a lot of people, a lot of resources happy to put people in touch with to help answer questions. And so, with that said, I will go ahead and just go through the Q&A. And if people have questions, please feel free to ask them. First one is what sites we can refer for rule of thumbs for cost. So that's very area specific. There is a company that publishes rules of thumbs per market. I actually forgot what it's called. Jackie, who runs our property management company, she's got a book this thick on her desk. Send me an email and I'll get you the name of that company. And, again, this is where just looking at other deals, getting more familiar with it, you start to see trends yourself as well, right? I cannot remember the name of that company. Let's see. Next question is, are we able to get a copy of these slides? Yeah, I'm happy to give out a copy. I'll give a copy of the slides to Haley. She can send it out to people. People can send an email as well. Happy to kind of get those out to people. There's nothing here that I'm happy to share. Next question. And if people have questions, please ask questions because I'm here all day to blocked out the next couple of hours. Let's see. So next question from Raj is asking if a deal reflects 6.75% return for the first year, then 7.25% for the second year, and so on. But the GP tells us there is a 10% preferred return. How do you interpret this for the passives? That's actually a great question, right? And so what Raj is really saying is a deal is showing that the investors are going to get, let's simplify it a little bit, Raj. A deal says year one, we're going to give you 6%. Year two, we're going to give you 7%. Year three, we're going to give you 8%. But we also said that it's a preferred return of 10%, right? And so what that means is that that deal is deficient on the preferred return, which is okay. Most deals cannot service the preferred return the first 2 years. And one thing I didn't say earlier for past investors, understand that this is all a moving and, kind of a moving target, right? And in the first year or two are not really good indications. There's still just so much unknown that things have to get resolved. But a good operator gets the deals performing by then. And so back to Roger's question, right? It's deficient in the pref. And so year one, he gave 6, but he owed 10. So now it's 4% deficient. Year two, it gave 7, but it owed 10, and it's now another 3. So your 4 plus 3 is 7%. So at the end of year two, that deal is 7% deficient in the preferred return. And so the way as an operator we resolve that, right, is ultimately at some point that deal is going to cash flow and be able to service the pref. And so let's say in year 4, the deal could pay 13%, right, out to, it distributes 13%. Well, 10% pref, so that, and now it's positive 3, but we owed, 7. Well, so that 3 will apply against the 7. So now it becomes a 4% deficient pref. And ultimately, you play that game until investors have gotten their pref in full. It's not deficient. And if there is a deficient pref left over, then whenever that property goes to sell, right, investors have to get what's called caught up on their pref first before the operators can begin to get that split, that 70-30. And so that's why, as an investor, you want to deal with a preferred return. I really recommend deals with a preferred return because, again, as the operator, I'm very motivated to make sure I can service and pay that pref in full, right? Because I'm not getting the upside until we can do that, right? Once it is paid in full, then we can essentially share that upside. All right. So next question is, what's a typical return on a B or C property that you offer? So it's really asking about pref rate, yearly IRR, and the hold period. So to date, deals that we look for, right, most of our deals are really, we're focusing more on Bs because the price between Cs and Bs has gotten so narrow that I'd rather get a better asset. But historically, it's really been B, C apartments. We look at anything from 100 to 500 units. We're buying a deal right now, it's 530 units, so it's, plus or minus. And on all the deals that we do, they're either a 7 or 8% preferred return to investors, meaning investors get 8% return on their money first before we split. And then from that, we're typically doing a 70-30 split. And the question is IRR, yearly IRR. So I didn't talk about IRR, and it's because it's a complicated subject for a passive investor. IRR stands for internal rate of return. And really quickly, so people can, I think I'm pretty good at distilling complicated concepts into simple things. What IRR means is it's basically what is your annualized return accounting for the velocity of time. And what I mean is compound interest, right? If I give you, let's say I'm giving you 2 different returns, right? You invested $100,000. I gave you nothing year 1, nothing year 2, nothing year 3, nothing year 4. And then year 5, I gave you your 100,000 and another 100,000. I doubled your money in 5 years. But you had no cash until the end of year 5. So your average annual return is 20%, right? But your IRR is actually much lower because you could not reinvest the money along the way. Now, let's say a different deal, same thing. It's a 5-year deal, but each year I gave you 20%. 20% year 1, 20% year 2, 20% year 3, 20% 4. The average annual is the same as the other deal. It's a 20% average annual return. But the IRR is actually much higher than the other deal because guess what? I gave you some money in your hands year 1. So year 1, you're able to take that 20% that I gave you and maybe go invest that in a different deal and start to generate more money, right? And so that's what IRR means. I don't like IRR too much for investors because it's very, very, very swayed by that reversion cap that we talked about, right? It really, because I've seen deals where they don't cash flow anything and then they're just hoping to sell at a really high price point. The IRR looks good, but in reality, it's not a very safe investment. And so to kind of close the thought, any deals that we do, we are looking for a 12.5 to 15 IRR risk adjusted. So it needs to make sense. If it's an A class, we're willing to get down to 12.5. If it's a C class, we're deep value add, we need to be 15, or higher. So and then last but not least, hold period. For us, most deals we model 5 to 7 year holds. But again, we're selling 6 deals this year, and every single one of them will end up being 2 to 4 years on those because, again, we're opportunistic. We will make an exit when we can. Our investors love that about us. Keep going. So Omar, how's it going, my friend? He said, can you please explain the goods and bads of a deal with a preferred return versus a deal with no preferred return? Okay, that's a good question. So it's ultimately, just to paraphrase it a little bit, the question is, you know, what's the good thing about a pref and what's the bad thing, right? And why would I want to do one deal versus the other? So personally, I am a fan of deals with pref because I always feel like it protects the investor and it aligns interest. We really like to structure deals where interests are aligned. The operator is motivated to get the deal performing because he's going to get paid once he can get his investors paid. That's why we like preferred returns. And, that's the good thing about them. Now, I guess the bad thing about them, right, is usually with a preferred return, right? And I'll just give you guys an example. We used to not have preferred returns. We previously would do a straight 80-20 splits on any profits, right? And it's the key thing is on any profits because investors' investment always gets paid back full first and then anything left over. So we used to do 80-20. Let's just see that. We used to do 80-20 split straight, but then we moved to doing an 8 pref with a 75-25 split, right? And so really net on a normal deal, the returns for those two deals are actually pretty much the exact same to investors, right? But now what's nice about the pref is if you notice what happened, it went from 80 to 75 return on the upside. And so a deal without a pref usually has essentially a more favorable investor split. And so as an investor, if it's a deal that is going to home run it, right? I mean, you don't even care about the pref because you're not thinking about the 8% preferred return, you're thinking about the 100%, right? It's a deep value add, et cetera, et cetera. You really believe in that deal. Well, obviously the pref, who cares about that? You care more about that split, that 75-25, that 80-20. And so typically a deal without a pref has a more favorable split for investors because they're trying to get the numbers to kind of tie up versus a deal with a pref. Essentially what we say as operators, like, look, we got investors paid, so now it's fair for us to get more upside. And so that's maybe the pros and cons, I'd say, between the two. And, it just varies, but it's, and this is where waterfalls, I mentioned waterfalls earlier, right? That's just talking about normal splits. Now, if there's also a waterfall, right? Because we've done deals where we just made tremendous amount of money for our investors. It was unbelievable. We should have done a waterfall. And what that really means is after investors made a certain amount of return, right? So we talked about the 8 pref, then maybe let's say after they made 12, maybe after that point in time, instead of it being a 75-25 split, it becomes a 70-30s, meaning we get more of the higher upside. And so pref is just kind of almost another tier in that structure. All right, let's see, next question. Do you keep the investor's money in the property or do you cash out, refinance, and buy more? That's a good question. So that's very operator specific. Us at Disrupt Equity, we are opportunistic and we've done both and we do both. And it really depends on the asset and what's going on. And, maybe to tell a little bit of a story, people always ask, why is that guy selling the deal? Right? We have a deal, like I said, it's closing Tuesday. Why are we selling that deal? The deal is doing well. We're distributing every month. It's a rock star deal. But someone is willing to pay me a premium on that deal, right? A higher, like they're really paying me a premium on that deal because they're going to come in with new capital, right? And take it to a higher level, right? And so we took it to a certain level of upgrades, but we don't have the new capital just laying around to be able to reinvest back in the property. And so that person buying it, essentially what their belief is, look, I'm buying it. Yeah, I'm going to pay you a little bit of a premium, but I'm going to come in with fresh money, a big chunk of money, and take it to another tier, another level, right? To where they're, instead of getting $1,000 rents, they're going for $1,200 rents, right? And, so in that case, right, we could do one of two things. We could refi and pull money out and give investors back a big slug and hold on to the deal. And that's fine, right? But again, we haven't been able to take it to another level, or we can let someone else pay us a premium more than what it's probably worth, right? And let them do that. And so there's pros and cons to both, right? It just depends on the deal, location. Is it a essentially a deal that you want to be in for 10 years because it's phenomenal location, great condition, or what? And so we've done both. It really varies by deal. And ultimately, we're just looking to maximize returns for investors because our belief is ultimately, look, you can pull money out and go put it in 3 deals versus stay in this one. Next question is, are non-accredited investors able to invest in your deals? So good question. So a couple things, right? There are typically in multifamily, right, regardless of who you invest with, there's two different types of structures. There's what's called the 506C and the 506B. right? 506C means that every investor has to be accredited, but we can market it. 506B means that we can accept what's called a sophisticated investor, right? They have to have some, knowledge. It has to be a pre-existing relationship. We can't market it, right? And there's a certain number of those that we can do. And so at Disrupt Equity, we do both. We've done both. It just depends on the deal and again what's going on. And as a passive investor, just understanding that, and don't really, that's something they should know up front. Are you accredited or are you not? And then make sure you're looking for what's called a 506B if you're not accredited, right? And yeah, you can obviously invest through the self-directed IRA. I want to make sure I mentioned that piece of it as well. It's important. All right. So let's see. Next question. Some waterfalls links the split to an IRR hurdle. So for example, if the IRR is 15%, then the split is 50-50, et cetera. What is the fair split at the fair IRR in this kind of structure? All right. So essentially what Omar is asking is saying he sees deals where there is a hurdle. So a hurdle just means after a certain return, right? Once investors have gotten a certain amount of return, the splits now change, usually more in favor of the operator because investors have already been paid a significant return. And he's asking what is fair. And I'll turn that around and say, it's all in the eye of the beholder, right? As an investor, if you made a strong return, do you care what someone else is making? You don't, right? I mean, you shouldn't care, right? It's about what are you getting on that type of deal and the risk that you took, and is it what you expected, right? The splits afterwards, I mean, even whenever I've invested in passively in many people's deals, right? My goal is to be the best operator. I invested in a lot of people's deals just to see who does, the good, the bad, the ugly. And ultimately, I just care to get what I was told, right? I don't care if they make $100 million as long as they delivered what they said. It doesn't matter. But typically, you see a hurdle or two and it becomes, I've seen hurdles where it becomes like exactly what you said, after 15% return, then it becomes a 50-50 split. And I've seen even another tier where after like an 18% return, it becomes a 70 in the operator's favor and 30 in the other. I don't really have an opinion on what's fair or what's not. It's ultimately just making sure investors, for the risk that they took, they are getting a fair return. Let's see, next question. As a passive investor, what are the top 3 risks in multifamily investing one should consider for B, C class, say in DFW market? Okay, good question. The top risks is property management is probably the biggest one, right? Property management can kill a deal, right? And it's really, we've had throughout our history of this company, we've had, I think, 6 different property management companies that we use. We used to use third party. We started our own management company a few years ago, and that's been phenomenal, right? We control everything. It's our own management company, and we also do third parties. Now other operators are having us manage their deals, right? Because property management is so crucial to performance, right? Because a bad property manager can get a property in a situation that's going to take 2 years to recover. So I think property management and is key, right? Along with obviously who that operator is, right? And make sure you're talking to someone that has a track record, right? They know what, they've done this before. They know who's good, who's bad. They know what to look for. Other thing is just, in DFW specifically, your question is understanding what the sell price looks like, right? We love DFW as a market. We have not been able to make deals pencil in on us. And so we haven't bought really anything in DFW because, we look at deals and maybe we can model it to where it makes sense. But if I'm buying it at a price and then I think I need to sell it in 6 years at a price that I don't think the market's ever going to get to, well, then I'm not very interested in that, right? I mean, a deal can only pencil so much. Ultimately, still needs to feel right. If you're buying your house today for $200,000 and you think you're going to sell it for $1 million in 5 years, probably not very realistic. Does it feel right? And other big risks is just, again, make sure the deal's well capitalized, right? In a DFW, it's a growing market, nice market, a lot of upside, landlord friendly. Some of these risks become less important, but on any deal, and again, we've done enough to where we've just learned this, right? And it's just being well capitalized, having a safety cushion so that the operator is not having to kind of scramble or try to go back to investors. All right. So let's see. Next question is, David asks, what is the minimum amount needed to invest in your deals? So, typically with any operator, it's really that $50,000 to $100,000 is what you see as the industry norm, right? Most of our deals are, it depends on the deal, but usually $75,000 minimums. It just depends on what's going on. Let's see. Next question is, have there been times when pref rate was less than the projected, and more importantly, didn't pay any pref at all for 5 to 7 years? So that's let's see. So I think as a question specific to us, we've never had a deal that we haven't paid pref for 5 to 7 years, right? Absolutely, there are deals where the pref is less than what's projected. Less than where it's what Omar asked earlier, where the pref is not serviced, right? Because again, whenever we're buying a deal, so if you remember the cap rate, right? Today, like I said, in Houston for B-class product, you're probably paying about 4.5% cap, right? Leverage that maybe gets you to 7% return. And if you remember, cap rate just means if I bought it and I did nothing, how much cash flow am I getting, right? Now, if I leverage it up, I get to maybe 7. That's still not enough to service an 8 pref, right? And so usually most deals are deficient. And if an operator is telling you day one, they're paying you the pref in full, what that usually means is they did something they probably shouldn't, which is they raised even extra money to give it back to investors as a distribution, right? Which is basically investors paying tax on their own money, which we're not really fans of. So typically for our deals, right, we first 6 months, we're kind of working through the business plan, and then we start to pay the pref. And then, also too, we make exits where it makes sense, and that's where we can catch up on the pref. So we actually had a deal we sold 4 months ago. On that deal, the play was really no cash flow for the first year and a half because it was a total turnaround, right? But it did have a pref, and whenever we sold the deal, we had to make the pref in full, and then whatever money's left over was split 70-30, and we still, I think on that deal, netted 40% annual to investors, so still did very well on that. And so understand that's where it's about, not just about just looking at the structure, but understanding the whole story and what's going on with that deal. Let's see. Kevin says, next question is, as I understand, if a preferred return is deficient in any 1 year, it must be made up at some time in the future, and another year, a more profitable year, or I'd sell. Exactly, right? If it's deficient, as the operator before we can start to basically participate in any of the positive cash flow splits, we have to make it current and full. So on the example I gave, right, on that deal, we basically said, let's just keep it simple. Let's say we sold it in 2 years, right? And it was an 8 pref. So that means, and we did no distributions because it was a deep turnaround. That means we were 16% deficient. So whenever it came time to sell the deal, we sold the deal. Then we sold the deal, we paid off the loan in full, and then we gave investors all their initial capital back, right? And then there is, I'm just gonna make up a number. Let's say there's 50%. Let's just say we raised $2 million on that deal and we had $1 million left over, right? So there's $1 million. Well, then from that $1 million, we had to give our investors enough money until they are current. So I mean, we had to give them the 18% of what they're owed, right? So now we are current on the pref, right? After that point in time. Then anything that's left over in the pot, that's whenever splits happen. And so, in that case, right, it said you either make it up with future distributions or on the sale. Let's see. And for the Quest folks, feel free to stop me anytime y'all want, but I'll keep going. So Norbert asks.
You're good.
Doing good? All right.
Those are really great questions. Yeah.
No, those are good questions. Let's see. Norbert asked, you mentioned about investing in properties where you can add value to them, but we also have to look for a good cap rate. So how do you combine cap rate and value when you fund your deals? What is a typical cap rate number you use? Oh, that's a very complicated question because there's a lot of reasons. There's a lot to think about. Ultimately, I like to tell people, if you have a vacant property, right, which means it has a 0 cap because it's got no cash flow and it probably actually has a negative cap, but ignore that, right? If you look at just pure cap rates in the equation for cap rate, that means it's worth $0. Is that worth $0? Probably not, right? There is still some value to it. And so if you kind of expand that thought process, right, there are some deals where they're not producing enough cash, right, and you need to buy them at a tighter cap than what the market is. Now, if it's a stabilized deal, there's not a lot to do for it. I expect to get market, right? But the example, actually, that same example I gave earlier, it was the deal where there was no cash flow for 2 years. On that deal, I don't even remember what the cap rate we paid was. It was definitely well below market, right? The market at the time might have been 5.5. We might have paid 3, right? Because that deal had 30 down units. We knew that there is value in that. All we had to do is get those down units online and we perform. And that's exactly what we did on that deal. And so that's kind of how to think about cap rates, right? It's really risk adjusted and where the deal is and what you're trying to do, right? But like I said earlier, in Houston, cap rates for B product is about, in that 4.5 to 5%, right? In Atlanta, honestly, Atlanta's hot. It's even compressed even more. I'm trying to think if I answered the whole question. How do you combine cap rate and value? Yeah. So it's really, that's maybe the answer. So it's just really thinking about the business plan and what cap rate we're buying it at. And is there a real pathway to success on that deal for that price? And ultimately we back into our price, right? We will literally model out the whole deal. And then we just keep reducing the price until we hit the returns that we need to for that business plan, right? If I got to go run a marathon, I need to get paid a lot more than if I got to go run a mile. So let's keep going then. So Zelma asked, is there a minimum investment amount? I think I already answered that. Most deals for us and other operators are in that $50,000 to $100,000 minimums. Joe asked, realizing the market is currently hot and great to sell, what is your view on buying new properties now and still being able to provide good returns to your investors moving forward? Okay, great question. So a couple things. Yes, it is a hard market. Yes, it is hard to find good deals, right? I wholeheartedly believe our team looks at more deals than anyone I know in the country, right? Because I mean, I'm a systems guy. I worked at Microsoft. We have it down to an art. We have a real process and many people involved along the way. It's very hard to find good deals, right? But there are still opportunities out there, right? We have a deal that's closing in 2 weeks. We're very excited about it because there's a real story. And this is where broker relationships matter, right? As a passive investor, you want to be investing with someone that really has good broker relationships because the brokers give us first look at deals, right? You get to understand the deal before anyone else is looking at it. And the seller usually has a price in mind. And we look at it, we say, okay, can we hit their price and can we implement a business plan that makes sense, right? But it is hard to find good deals out there, and it's really numbers. I mean, we went at our firm, we went 18 months without buying a single deal, right? We're patient. Our goal is to do 100 deals. How do we build a track record to get along the way? And so it's really kind of a numbers game. It's all relationship driven, and it's really about understanding that story. Is there something there that someone else missed that we can see to kind of really perform on? And I think maybe the other part of your question is about returns, right? Yeah, returns, across the board, returns have dropped, right? And ultimately, I like to say I can buy any deal in the world if my investors are okay with those returns, right? Meaning if I have investors that only want a 1% return, I can go buy a deal in downtown Manhattan, right? And so ultimately, as we've grown, as our track record has been really matured, our investors trust us and we try to deliver on what we say, but returns have dropped, right? The deals that we were presenting 5 years ago are very different than the deals that we're presenting now, right? And so the returns back then we projected higher, and now we're projecting less because we're paying more for them. And this is where, it's a hot market. Do we know it's going to stay hot? I don't know. But if you're investing in deals, just make sure your operator has a real plan to, navigate the waters if there's some rough seas, right? And so for reference, I guess the deal that we're buying in 2 weeks, that deal, we went low leverage, right? By design. We literally did a low leverage deal. We raised a lot more money with our investors, right? We could have, I think on that deal, we raised 24 million. We could have done a higher leverage deal and raised only 15 million or somewhere around, I think 15 million. But we intentionally chose to raise more money, which, yes, it would reduce returns a little bit, but it would make it a significantly safer investment. So if the market changes, it turns on us, we still are sitting on a lot of equity to be able to make the next move. And so it's really understanding that dynamic. Next question, Gabriel says, how can we combat these moratoriums? That's a great question. Right to your Congress people, hopefully that'll wind down, right? And ultimately, people think evictions stopped, and really there are some evictions still happening, right? We are still able to do some, and it's really about the tenant. Are they claiming the CDC or not, right? Not all tenants can claim that or do claim that. And, luckily, right, we've had, especially in Texas, we've had the Texas Rent Relief Program. Our property management company has been very, very diligent about making sure we continue to apply. That's helped. And ultimately, my hope is moratoriums kind of quickly dwindle away as the economy gets caught back up. Another question, how much skin in the game should the GP have in a percentage basis in a deal? Okay, this is a good question. And it's really something I didn't even mention earlier. I think it's very important that you as a passive investor are investing in deals that the operator is very motivated to make perform, right? Obviously, a deal with a Pref and they're only getting upside after the Pref, that makes them motivated, right? But them having money in the game on your side of the table makes them even more motivated, right? And so me and my partner invest in every single one of our deals. And I like to make a joke that, our biggest deals have been my lowest investments and our lower return deals have been my highest, right? And it's important to have skin in the game. The question here is how much skin in the game, as a percentage. I don't think as a percentage makes sense, right? And I'll give you the example. The deal we're buying right now, I said we went in lower leverage. So we raised a significant more amount of money from our investors, right? And so let's just say I told you that number is 10%, right? I told you we could have raised 15 million, but instead we decided to raise 24. Let's keep it simple, 25 million. 10% of 15 is 1.5 million. 10% of 25 is 2.5 million. On that deal, I don't think it's fair to say the operator needs to put in another million so they stay at that 10%. But I do think it needs to be a healthy amount for that operator, right? I don't think it should be an operator putting in $10,000 slugs in every deal. I think they should be putting in $75,000 to $200,000 slugs. And this is where, as a passive investor, it's fair to ask, how much is the GP team putting in, right? The deal that we are buying, our GP team is putting in $2 million collectively between us and our partners, right? And it's actually closer to 2.5. Our investors love that because, and that model actually happened to be about 10%, but that is what motivates us to get the deal performing, right? Because we are sitting alongside our investors. We're not just a different tier. Let's keep going. Next question. Any red flags to watch out for when screening operator syndicators? I went through a bunch of them throughout this presentation. If you missed the first part, definitely give it a watch. But other things, just invest with people that you like, know, and trust people, right? For those of you actually here in Houston, we run a meetup every month. Feel free to reach out to us, and you can get to like, know, and trust us, right? And we were out there, we meet people. We had one actually 2 days ago. About 100 people showed up. And so invest with people that you like, know, and trust. Ask for referrals. Talk to people that have invested with them. And just see if it's a fit, right? Not every operator is a fit for you, right? Not everyone of you I'm a fit for, probably, right? Hopefully we are, but get to know the person, get to know the story. Don't just invest blindly, right? Because there are some people that just really fly by night. They show up, try to do a deal, and then they disappear and the deal doesn't perform, right? Don't invest with those people. Look for people that have a real plan, that have a firm behind them, or and if they're new to the business, that's okay too. But understand that as you're going in. And I will say this, there's a lot of smoke and mirrors, unfortunately, in this business, right? People really like to use unit counts as if it's the holy grail, and maybe they're just, a small piece of a big deal and all that. Understand that and try to filter through that and just understand who you're investing with. What has that person truly done? And is that a fit for you? Let's see. What are your thoughts on different pref return tiers within the same deal? Okay, this is a really good question because I have a lot of thoughts on this. So the question is ultimately, because it's a hotter market, you are starting to see more deals that are structured more creatively, right? And so if you think about it, most deals, let's say the loan is leveraging to 75%. So there's that 25% gap that usually you raise investor money on. Now, the problem is investor money is more expensive than loan money, right? If I have any investor that wants the same return as a loan, please reach out to me. I'm happy to give you that, right? But we pay on our loans 2.8 to 3.5% return. My investors would kill me if I gave them that, right? So investor money is always more expensive. So now to fill the rest of that gap, people are starting to structure different tiers, right? Where they have a bucket that is a certain amount of return and the bucket that's the other. And really, I know that your example was talking about the person that invests 100 gets more than the person that gets 50. That's not really what it is. It's really what they're saying. There's two classes of investor shares. And what they're trying to say is, look, you can invest money and get a 10% fixed return, right? Usually it's about 10%. Or you can invest in a different class and you don't get the fixed return, but you get more of the upside, right? And what I caution investors on is really understand what those classes are, because the problem is usually those classes are structuring in what's called a preferred equity slug, not preferred return, preferred equity. What that means is, so if you think about whenever there is cash, always the first lien, the lender has to get paid first, right? So they get paid off. Then what the preferred equity piece has to get paid in full as well. So those investors have to always get paid first. Then whatever's left over goes to the remaining of the investors, right? And so the problem is that those investors are essentially taking on a lot of the risk for more of the returns, yes, but they're taking on more risk. And so I caution all investors, if you're investing in a deal that has multiple class tiers, right, just understand how big is each class, right? Because I'll give you an example. Let's say, again, the loan is 75%. Let's say the preferred equity slug is bringing it up to 95%, which I hope no one is investing in those kind of deals, but let's just say it is, right? So then the last 5% is the investors that can get all the upside in the world, right? But they're paid last. And in my mind, those people are taking on almost all the risk because these guys have to be paid in full and these guys have to be paid in full before anyone else. It's a very complicated topic. Understand what those are. And it's not to say that Pref is bad. Pref equity is actually, as if I would love to be the Pref equity lender, right, in that position. And it's okay to invest in deals with Pref equity, but just make sure that it's not a significant amount of the raise, right? But what Pref equity does help with, right, it's a tool. It needs to be used correctly. It's as a tool, it allows the investors to essentially, it gives certain people fixed returns, right? Those 10% guys, but it gives the other guys more upside in that deal, right? And it allows the deal to work, right? Because otherwise you can't pay everybody that higher return. And so you kind of get different risk tolerances. All right, let's keep going. Second part of my question, just to be clear, if a deal is non-preferred, then it is not required to make up interest deficit at any time in the future or at the sale. Example, interest is just lost. Correct. Right. If there's no pref, they don't have to make up anything. You have to always pay back investors in full. And again, please read your company agreement, make sure that's the case. But then anything left over is just being split straight between passive investors and the operators. Next question is, do you do new development? We've done a new development project. We think right now in this hot of a market, we are looking at a lot more of those projects, and we're kind of looking to actually hire on a full-time person in-house focused on that piece of it. But yeah, we've done some. That's not our core focus, but we're absolutely going to be presenting those kind of offerings to our investors. Let's see, how many deals has Disrupt Equity gone full cycle on? What you recommend investing with an operator that has not go, well, would I recommend investing with an operator that's not go full cycle? So by the end of this year, Disrupt Equity would have done, I think, 9 full cycle deals, right? So that's deals start to finish. We bought them, did the business plan, sold them, great returns on them. Happy to kind of show those out if anyone reaches out on that. And the question is, would you recommend investing with an operator that's not gone full cycle? It's all about the deal, guys, right? And this is where the operator needs to be able to perform, right? But the deal is also the hardest part of it all. And so, full cycle is one thing, right? But maybe full cycle doesn't mean anything. So we could, at the same time, like I said, we would have done 9 full cycle deals. We could have just refied all of them, and then it's not really considered full cycle. Maybe the question is more so, how long have they been in the business and how have the current deals performed? That's really the question I think to ask. And yes, I would invest in people that haven't gone full cycle. I know some operators that are very good operators and they actually haven't done full cycle. They haven't either been in the business long enough or they chose to refi. They haven't sold the deal, right? But for us, our MO is really maximizing opportunity for our investors, and we'll make the exit where it makes sense. Let's see, GP skin in the game. What about when there's an acquisition fee that seems to neutralize the GP equity in the deal? Okay, so that's a good question. It's a complicated question. I would say this though, the acquisition fee, there's a lot of energy that goes into finding a deal and putting a deal together, right? And I used to, whenever I was purely passive investor before, I used to also be more kind of leery of that fee. But now being on the operator side, I see it firsthand, right? We have, like I said, Disrupt Management's got 120 employees. Disrupt Equity's got 12, right, people. And there's a significant amount of manpower that goes into underwriting the hundreds of deals that we look at to find that one. So typically, our acquisition fee is really focusing on that piece of it, right? Helping, to kind of find the deal. And so that's really, it's just the opinion of the investor. Let's see, next question. Do we need to do any due diligence on quarterly/annual reports from sponsor to verify data given is real and not fake? If so, how? So that's a good question. So I don't know any sponsors that essentially do annual audits of their stuff, right? I know big funds legally have to, right? Ultimately, Kevin, A, you need to be investing with someone that you trust is the first thing. B, most, hopefully the management company is its own entity and it's a trusted entity as well, right? And C, again, as a passive investor, you're allowed to ask questions, right? If an operator's not answering questions or not willing to share data, that's probably a red flag in itself, right? And so, ultimately verifying the data, it's really hard, right? You can definitely do it, right? If a person is completely unethical, not performing, then by all means, right, you get into that. But that's a hard thing to kind of go through. Next question. Does Disrupt currently invest or plan to invest in other assets beyond multifamily apartments? For us personally, yeah. So RMO is, we are not Disrupt Multifamily, we are Disrupt Equity. We ultimately, multifamily is what we do A to Z. We find the deal, we operate the deal, we close the deal, we have our management company, we manage for other people. That is our expertise because it's the hardest of the asset classes. It's by design, right? Think about it. I mean, I'm in our office building right now. This office building is about, I think, 120,000 square feet. I think the whole office building has probably 8 toilets, right? Our apartments, we have 300 unit apartments. Heck, the apartment that we're buying right now, 500 unit apartment that's got probably 1,200 toilets, right? It's a much more difficult asset class. In an office building, you have much higher quality tenants that are probably going to pay. Apartments, not so much. So it's a harder asset class. That's why we focus on really nailing it down, being the best in class at that. Then for other opportunities, we will get educated, and usually we will partner with other people. So we have other operators that are good operators in their markets, and we will partner with them. We will vet the deal, validate the deal, and we can kind of work on them with our partners. So that's kind of the vision for Disrupt Equity. And I guess that's the last question. So I'll call it a wrap there before people come.
Yeah, what a great question to end on. But Feras, go ahead and wrap it up. Do you have any last advice or things you'd like to mention to our audience today?
Yeah. So, I mean, last but not least, people, right? It's really a relationship business, right? I love multifamily because it's people's numbers systems, right? And it's all relationship. And that includes with the passive investors. Get to know the operators, vet the operators, talk to people that have performed with them, right? And ultimately, put your money to work, right? That's what's exciting. That's being here, right? And like I said, even getting connected to Quest. I mean, I remember 7 years ago coming out to one of their events. They do a good job getting educated, right? Educating investors. They see that as well as us. Getting educated and getting educated investors is crucial because it helps them place their money effectively, and it helps us have people that understand what the plan is and what that looks like. And so with that said, if anyone reach out to me, feel free to send me an email. Haley, thank you guys for having us. You guys are world-class acts and do a great job kind of putting these on. I love that y'all go out there and educate the investors on everything because, again, I'm sure it makes your lives a lot easier.
Oh, yeah, definitely. Because you can't successfully invest if you don't have the right education. And that's really kind of the core behind why we do all of this. So Feras, thank you so much for joining us today. And gosh, you made my job so easy today. You answered almost 30 questions all on your own, and almost the majority of our 100+ attendees stayed on for the entire Q&A. So I think that really speaks volumes of the type of education that you offered today. So thanks for joining us. I hope you all enjoy the rest of your weekend. Y'all be sure to check out our other webinars and events that we have coming up. You can find all of that information on our website. And Feras, it's great to see you. I'm sure I'll see you soon at one of the other.
Absolutely. Thank you, Haley. I appreciate it. Thank you all.
Yeah. Y'all have a great day, everyone. See you later.